Hello everyone. So in this video I'm going to talk about writing covered calls or selling covered calls. So I'm going to assume that you already know what options are, call options and put options. If you don't know what they are, there's a link in the description below the video. Watch this video first and then come back and watch this video here on writing covered calls. Because in this video I'm only going to talk about writing covered calls and the strategy behind it and why people use it. So the best way to explain it is really to show several examples. So I'm going to use Ford as an example. So basically writing covered calls, you use it. It's a strategy that allows you to make money from a stock that doesn't move much, that doesn't fluctuate much. So basically what you're doing is you're selling the call options. But before doing that, you have to own the shares first, and you have to own at least 100 shares because an option contract is 100 shares. So before you can start selling option contracts, you need to own the shares of that stock. So you need to own at least 100 shares of that stock. So for example, let's say Ford right now trading at 9.27. So if we're going to buy 100 shares of Ford, it's going to cost us $927 plus $5 fee. So it's going to cost us $932, and we will have 100 shares of Ford. Once we have 100 shares of Ford, we can start writing covered calls. So then you'd go into the option table of the stock. You would choose the period that you want. Best way, or most people use this strategy by looking at 1 month expirations, and that's how they generate a monthly revenue, by owning a stock. So let's say we look at 30-day expiration from today. So what, we're 25th or 26th today? We're 26. So let's look at October 26th, 2018 expiration date. So we bought the shares of Ford at 9.27. Now we're going to look at the strike price. So any strike price below the market price is called in the money, and any strike price above the current market price is called out of the money. All right, so we bought our 9.27. We're gonna have to pick a strike price that of course is above our market price. So let's say we pick $10 as a strike price. So you can see here that the call option, the premium for October 26 expiration date for the strike price of $10, the bid is 6 cents and the ask is 7 cents. So if we want to sell it, that means we want someone to buy it from us. So, and the bid for it is 6. So in this case, there isn't a big gap, but usually when there's a big gap, you can probably ask for something in the middle. So for example, between 15 and 18 over here, where you could probably ask for like 16 or 17. But if we look at the $10 strike price, let's say we're able to sell it at 7 cents. So we own 100 shares of Ford at 9.27 that we bought at 9.27. And now we want to sell call options at strike price 10. So by selling one contract, that means 100 shares. So that means for that call option, we'd be collecting 100 times 0.07. Let's say we sell it at 7 cents. So we'd be collecting $7. So we own the stock, we own 100 shares of Ford, and we're selling the call option, and by selling it, we're getting $7. And what that means is from now till the expiration date of October 26th, there's 3 scenarios that could happen. First scenario, the stock drops. So if the stock drops, you still own the shares. They're just worth less, but you still own 100 shares of Ford. The $7 that you sold, that you collected, they're still yours. You sold the call option, they're yours. And since the call option is going to decrease in value, they're going to expire worthless, and you don't have to do anything. So in the scenario where the stock drops, you collected $7 and you still own the shares. In the scenario where the stock stays the same by expiration date, you will have collected $7 and the stock, you still own the shares. Now in the scenario where the stock goes up, so since we chose a strike price of $10, if it goes above the strike price of $10, if it goes, let's say, to 10.25, well, that means your options are going to get exercised. Someone is going to buy because you sold your call options, that means someone bought the call option, so someone's going to exercise it. So that means the 100 shares that you have, they're going to have to be sold, and they're going to be sold at $10 because that's the strike price you chose. So you're going to get the $7 that you collected from selling the call option, and you're going to get the capital gain from selling your stock at $10. So you're not going to sell at the market value, you're going to sell at the strike price. So you're going to sell at $10 minus 9.27. So you're going to get, in this example, you're going to get a capital gain of 10 divided by 9.27. You're going to get a capital gain of almost 8%. That would be in 1 month. So that's if the stock price goes above your strike price. In this scenario, you'd get a capital gain of 8%. You'd get your $7 that you collected of call options. And if there were any dividends, you would have also collected the dividends. So at $7 on an investment of $927, that is not even 1%, but that's in just 1 month. So if you do that times 12, if you were to repeat this every month, you'd be making 9% just from selling covered calls. But this is just an example. It's not necessarily the best example. The trick or the research or the strategy in this is to find the stocks that have good call options to sell. And remember, I said if you sell the call option, you'd be getting $7, but there are fees involved, and obviously the fees surpass the $7. With Questrade, you'd be paying $11 just for this transaction. So it wouldn't be a good idea to sell this call option or to write covered calls in this case. And with Investor's Edge, it would be around $8.25. But let's say we, instead of having 100 shares, let's say we had 1,000 shares. So with volume, this works. This works better with volume. So if you have 1,000 shares of Ford, you bought at 9.27, so you invested 9,270. So you've got 1,000 shares, so that's 10 options, right? 1,000 divided by 100, because there's 100 shares per contract. So you've got 10 contracts. So the fee for selling 10 contracts is, with Questrade, for example, it's a fixed fee of $10 plus $1 per contract. So it's going to cost you, to sell 10 contracts, it's going to cost you $20 with Questrade. So let's say we go back to our same example. We're selling it at 7 cents, but we've got 1,000 shares. So if we own 1,000 shares of Ford and we sell the call option against it, we'd be collecting 7 cents times 1,000 shares. We'd be collecting $70 minus the fees. So we'd be making a profit of $50 that we're just collecting for owning 1,000 shares of Ford and selling the call options. Because we do this strategy, we can't sell our shares during the period of the call option. We have to wait till expiry. And 3 scenarios can happen at expiry. Either a stock drops, you keep your $50, you keep your shares. Stock doesn't move, same thing. Stock goes above the strike price that you sold the call option at, you're gonna automatically sell the shares will automatically sell or liquidate at $10. So you're gonna make a gain of $10 minus 927 times 1,000 shares. So you're gonna make a gain of $730 by selling at your strike price, and you're gonna keep the $50 that you collected from selling the call option. So the only downside to this is that you're limiting your upside. Because let's say the stock goes to 12, you'll have to sell at 10. So you missed out on an extra $2 per share. So it's unlikely, but that's the only downside with writing covered calls, is that you might limit your upside. You might limit your potential gain. But what's good is you're collecting a revenue, you're collecting income from the shares that you're holding. Besides the dividends, you're collecting the premiums that you're selling, the call options that you're selling, and you lose the ability to sell the shares whenever you want because you have to hold them until expiry. And at expiry, either you keep the shares and you keep the call options, or you're going to have to sell it at strike price if the market price goes above the strike price. But that's why you should always choose a strike price that's higher than the price you bought it at, to give yourself at least a decent capital gain. So in this example, 10 divided by 9.27 is about 8%. So about an 8% gain in 1 month. But what usually happens is stock does not go past your strike price, so you end up collecting the premiums of the call options for free. So in this case, if you have 1,000 shares, you'd end up collecting $50. So remember, we invested 9,270, but we collected $50. So $50 on 9,270 is 0.5%, which would give us around 6% per year if we apply this strategy every month for a year. But this isn't the best example because the price isn't so good. But let's look at another example. Let's look at another stock. Let's look at GE, for example. So if we choose expiry date October 26, let's say we buy 1,000 shares of GE at 11.39. So that means we're gonna have invested 11,390, and we decide to sell the call option. So we want a decent gain. So we want a strike price that's slightly higher. Well, not slightly, but higher than our market price. So let's say we take 12.50, right? Or let's say we take 12. So what? 12 divided by 11.39 gives us a 5% gain. So let's just, for this example, let's just use 12. So we choose a strike price of 12. We bought 1,000 shares first of General Electric at 11.39, and then we decide to sell the call option at strike price 12. Strike price needs to be higher than the price that you bought it at. So whenever you're forced to sell, at least you made a capital gain. And we're gonna sell the call option, let's say at 25 cents. As you can see here, the bid is 21, the ask is 25. So in real life, it's gonna be something in between, but for this example, we're just gonna say 25 cents. So that means we're gonna collect, from selling this call option, we're gonna collect 1,000 times 25 cents. We're gonna collect $250 by selling the call option. So we own the shares. We own 1,000 shares of General Electric at 11.39. We sell the call option. We get $250 for it, and that means we have to keep the stock for a month. If the stock drops, we still keep our $250 and we keep our shares. If the stock stays below our strike price, we keep the shares and we keep the $250. If it goes above the strike price, it automatically sells. So we're gonna keep the $250, but we're also gonna sell the 1,000 shares. So 12 minus 11.39, 61 cents times 1,000 shares. So we would have made $610 plus the $250, right? So we would have made $860 divided by our initial investment of 11,390. So we would have made 7% in 1 month with this strategy. That's if the stock price goes above the strike price within 30 days. What usually happens, it doesn't. So you end up keeping the shares and you end up collecting $250 for free. So, and $250 divided by 11,390 in that case represents 2% per month divided by 12. That's 26%. So in this case, we'd be collecting 26% per year by applying this strategy. So in this case, GE is a better choice than Ford if you apply this strategy, because the options are better priced for this strategy. But obviously, you're going to have to buy 1,000 shares of GE in order to do this. And when the stock drops, you could do it again the next month, but you're going to have to do it on a smaller. So the risk is if the stock drops, so we initially bought at 11.39 and we use strike price 12. If the stock drops, the call options at the $12 strike price will no longer be 25 cents. It's going to be much lower. So you're not going to get 2% every month. That's if the stock drops. Might be 15 cents. And you can't take a strike price that's lower than what you bought it at. So your strike price needs to be higher than what you bought it at. In the case where you're forced to liquidate, you're forced to sell, well then you're selling at a profit. So basically you're choosing the minimum profit that you want to take out of this stock in case it sells, and while you're waiting for the stock to surpass your strike price, you're collecting premiums every month. So you're happier if the stock doesn't move and stays the way it is, because that way you're collecting premiums every month and you're making 26% per year in the case of GE. Oh, sorry, I forgot to remove the fee. So on $250, it was 10 contracts, so you'd remove $20. So that would be $230 divided by 11,390. So it's still 2% times 12, so it's like 24%, yeah. So let's say we choose a higher strike price because we want a higher capital gain. If we chose $12.50, so that and we sell the call options, so let's say we're collecting 13 cents and we have 1,000 shares, so we'd be collecting $130. And if at expiry date, if the stock, or anytime before the expiry date, the stock surpasses $12.50, what's going to happen is you keep the $130, but you're going to have to sell your stock, liquidate your stocks at $12.50, but you bought it at $11.39, so you're making $1.11 per share. So you'd make a $1,110 profit plus your $130 from the call options, or $110, so $12.20. So in this scenario, $110 times 12 divided by 11,390, you'd be making 11.5% if you're selling the call option every month, assuming that the price doesn't fluctuate much and you're able to get 13 cents every time. So the closer you are to your market price, the higher the return. But obviously, if the higher the chance that the stock price reaches your strike price, and you're forced to sell and make a small gain, and you limit your potential upside. So let's look at another example here. Let's try AT&T. Remember, while you're holding the stocks, if there are any dividends paid out, you'd be getting the dividends as well. So if you're holding it for a year, you'd be getting dividends of a year plus call premiums that you're selling every month. And if you end up selling, you get the capital gain as well. So let's look at AT&T. It's trading at $33.35. So we buy 1,000 shares. So that'll be what, 33,000. Yeah, so that'll be 33,350. So we bought at $33.35. So we want a strike price that's far enough to give us a good capital gain. So let's say we take 35. See, in this example, as you can see, it's only worth 1 cent. So this is not a good example. We'd have to be at $33.50 in order to collect 12 cents. So AT&T would not be a good example. That wouldn't be a strategy to apply. Let's try a bank. Let's try BNS, Bank of Nova Scotia. So October 26th. Yeah, all they have is October 19th. So let's look at November 16, 2018. We buy the stock. So this is in US. We buy it at $59.61. So that would be $59,000. And the only strike price available here is 60. All right, so that's not a good example. Does it have? All right, so let's choose expiry date October 19, 2018. Buy at $59.61. Strike price would be 65. But as you can see here, we'd only be collecting 5 cents. So yeah, so this is not a good example either. But just for example purposes, if we'd be collecting 5 cents, so 5 cents times 1,000 shares, that'd be $50 minus $20 of fees. So you're at $30. 30 times 12, $360 per year divided by your 59,610. So yeah, so that's not worth it at all. So this is a bad example. So as you can see, we looked at Ford, GE, AT&T, Bank of Nova Scotia. Only GE was a good stock to apply this strategy at. So that's why it's not so easy, because or else everyone would be applying it, but you really have to find the stock that makes this strategy work. And obviously it works with volume. When you have a lot of shares, even if it's a few pennies that you're collecting per share, it's still free money that you're collecting, and it surpasses the fees, of course, and you still own the shares. So you could, after expiry date, you can sell the shares, you're still collecting dividends, or you can repeat the process and collect call premiums again. So regardless, it's still important to buy a stock at the right price, because if you buy too high and then the next month it drops, if we go back to GE, so if you buy it at 11.39 but then next month it drops to 9, well then you still have to choose a strike price that's higher than what you bought it at. Let's say you choose 12, you're not going to be getting 25 cents anymore. It's going to be worth like maybe 5 cents or less. So then you wouldn't be able to apply that strategy anymore. You're gonna own shares that's lower than, that has a lower value than what you bought it at, and all you could do is collect dividends and wait for the stock to come back up. And you can't just choose a strike price that's lower than what you bought it at, because if you do, if the stock price goes above 10, you're gonna be forced to sell, and you're gonna sell at a loss because you bought it at 11.39, and you're gonna have to sell at 10. So it works if you're confident that it's not gonna go above a strike price, even if the strike price is lower than what you bought it at. It could still work, but it's much riskier, because if it does surpass that lower strike price, you're gonna have to sell at a loss because you bought it at 11.39. So that's the risk with selling covered calls. You limit your upside, and if the stock price drops a lot, then you can't apply the strategy anymore. So it's perfect for a stock that doesn't fluctuate much, that doesn't move much. That's where this strategy works, and it doesn't work with every stock. You really need to see which ones make it worth it. So you could do it every month, or you could even do it on a yearly basis, but then of course you're forced to hold the stock for a full year. So for example, let's say we take it for a full year. Let's say, what are we? We're in October. Let's say we go June 2019. So let's say we buy 1,000 shares of GE at 11.39, and we're happy, in 1 year we're happy selling the stock at 13, let's say. So we're happy making a capital gain of 14% in 1 year. It's actually even less than 1 year, in 9 months about. So let's say we're happy selling the stock at 13. We bought it at 11.39. We're happy selling it at 13. So to make a 14% gain in 9 months. So if that's the case, then right away you'd go to strike price 13 with expiry date June 21st, 2019, and you'd sell the call option here at 64 cents. So that means you'd be collecting 64 cents times 1,000 shares. So you'd be collecting $640 right away, but you're forced to hold the shares until expiry of June 21st, 2019. And three things can happen. The stock continues to drop. You still have your $640 that you collected. You still own 1,000 shares of GE. You're still going to collect the dividends on GE. If the stock stays neutral, you can't repeat the process. You have to wait till the expiry date. So you're collecting the dividends. You still hold the shares. You still have your $640. If the price goes above your strike price of 13, you're going to sell automatically. So you're going to make your 14% capital gain. You will have collected your dividends, and you will have your $640 that you collected in call premiums by selling them. If it surpasses the expiry date and you did not, and the price did not reach 13 or higher, then you still own the shares. You could repeat the process. You could sell the shares. Well, it'll be completely up to you. So that's the strategy of covered calls. And like I said, it's best applied when a stock doesn't move much. So you can take advantage of, so you can make money off stocks that don't move, basically. So you can collect the dividends, but you can also collect call premiums every month, or every 3 months, or every 6 months, depending on the expiry date that you choose. But during the option period, you have to hold the stock. You cannot sell it. it'll sell automatically if the stock price surpasses your strike price. Alright, I hope this wasn't too confusing, and like I said, you need volume in order for the strategy to work because of the fees and because the call premiums aren't so high. Actually, let's look at Ford. If you have, I think I have 200 shares of Ford, let's say I have 200 shares of Ford, but this time I'm going to choose an expiry date. Let's say I go for 1 year. Actually, let's say I go for January 2020. So a year and 3 months, a year and 2 months. So I got Ford shares that I bought at $10, right? So I'd be happy after a year, I'd be happy selling Ford at 12. Definitely, that would be 20% in a year. So that's perfect. I'd be happy selling at 12. So I could look at the strike price at 12. If I sell the call options, I'd be collecting today, I'd be collecting, let's say 30 cents for this example. So I'd be collecting 30 cents times 200 shares. So that's $60 minus $12 of fees. That's $48. So I could do that strategy, sell call options, collect $48 now, but I would have to hold the stock until January 17, 2020. Whatever happens in the middle, if it goes lower, can't sell. I'm only going to be collecting dividends. The only way I'll sell is if it surpasses $12 between now and January 17, 2020. If it surpasses $12, it's going to liquidate automatically, and that's good because I would have made $48 plus 20% capital gain, plus any dividends I would have collected in the way. So that could work. So with a small amount of shares, with lower volume, it works, but you're going to have to pick a longer expiration period, an expiration date that's further. If you want to apply it monthly, you're going to need volume. Alright, so if you have any questions, leave them in the comments below. Remember, if you're going to open an account with Questrade, use my referral code in the description below the video, so you can get between $25 and $250, depending on your initial deposit. Thanks for watching.